In this video, guys, we're going to look at what was Rule 48 and have a little look at circuit breakers also. Stay tuned. Hey guys, a very warm welcome to. So I've done a separate video exclusively on circuit breakers. Go and check that out if that interests you. But what was Rule 48? So Rule 48 came about in January of 2008. It was kind of put forth in December 2007 as a way of opening stocks when things were going a little bit crazy. So the idea was you could get stocks on the New York Stock Exchange open quicker when Rule 48 was invoked. Now, normally what would happen is you've got the hybrid model with the NYSE compared to, say, the NASDAQ, where designated market makers would have to come up with an opening price, the floor manager would have to okay it, bang, that goes out, market can't open until the opening price comes on. When there's lots of stuff going on, they might not be able to do that for a long time. There might be a lot of orders coming in, there might be a lot of volatility. And so the idea of Rule 48 is you don't have to wait for that opening price. We can just get trade going. The idea is it opens up the market quicker, just gets trade flowing, which is what everyone wants. Everyone wants that two-way trade to be able to deal whether they're buying or selling. So there were four things that kind of you had to look at, and any one of these four would mean that Rule 48 could potentially be invoked on the New York Stock Exchange. The first one is high levels of volatility. So from the prior day, there was a lot of volatility and they're expecting that to follow on today. Rule 48 might be invoked to reduce the load and the kind of problems that the designated market makers would have in creating an opening price. Trade will just get going. So high levels of volatility on the prior day. Then we've got foreign market volatility. So let's say China was going really crazy, Europe perhaps, and it was indicative that the US markets may well follow suit. Rule 48 comes into play. And number three is extreme pre-open selling. So looking at the futures here, so look at the S&P 500 futures, Dow futures, whatever it may be. If those have been hit hard, then potentially you're going to expect the index to be hit harder. Well, obviously there's going to be a gap lower based on the futures price, but you might expect a lot of stock activity, a lot of people hitting orders into the NYSE and not being able to cope with that, designated market makers not being able to cope with it, not being able to get an opening print out. So let's just get trade rolling. So by the way, this is worth pointing out. This very rarely, if I don't know even if there has been a time, let me know guys if you know, when Rule 48 gets invoked to the upside. It just doesn't happen because panic happens to the downside generally. This is to kind of stem people's panic. When things are looking like they're going to be really blood red, Rule 48 come into play. The final thing here, guys, is macro news. So if we've got some kind of news that's come out before the open, which could heavily impact, and it's got to be serious news, not talking about just a little miss on non-farm payroll numbers or something, then potentially that could invoke Rule 48. Normally, you're going to get a combination of these, right? You're normally going to get, perhaps high levels of volatility the day before. The DAX might have been going crazy. The futures are going to be getting hammered based on what the DAX is doing. It might have been because of news. So you might get multiple of these, but ultimately those are the four things that are allowed to be used as a reason to invoke Rule 48. In 2016, they got rid of it because it was invoked many times over the debt crisis, European debt crisis. It was even invoked during a New York blizzard. And they had problems where ultimately the opening price wasn't printed because Rule 48 was in play, and some people were selling stock at a significantly lower price than they should have been. So there was the time when Apple went down to around $93, which was way lower, and basically it was a panic opening print that people were panicking. They didn't really have a benchmark, and it ended up becoming an absolute mess. It caused more problems than good. So 2016, they said, let's get rid of it. We won't use it anymore. So that's been and gone, guys. Rule 48 is no more. However, circuit breakers are still in play. Individual stock circuit breakers are in play. Like I say, go and check out a video where I've talked about this in length. But, if you look at the S&P 500, when it's trading along, you've got three levels: level 1, level 2, and level 3. Level 1 and level 2, if it hits 7% or 13% before 3:25 p.m., then trading will be halted for 15 minutes. So 15-minute halt, let everyone calm themselves down a bit, off we go again. If it's after 3:25, no halt, no problem. Level 3, however, the 20% level, then trading stops for the day. If it's down 20% during the trading hours, trading stops completely for the day, no more trading. It's different pre-market and it's different for stocks, but we still have these circuit breakers in place. The point is, there are things to stop ultimate heavy selling panic, but it's a fine line, right? Do you try and stop it, or do you try and let it resolve itself? Flash cash resolved itself ultimately. If it had stopped, it would have created more panic. So the authorities are kind of tossing up what the best thing to do is. What they don't want is to stop people from selling, and then they come on and it's flooded and it creates more panic. But then they don't want to overwhelm it so there's no liquidity on the buy side. So they're trying to find that fine line. So Rule 48 is gone, circuit breakers are still in play. There's still some things in there, but to me, that's pretty extreme. If the S&P is down 20%, there's a lot of problems out there. All right, guys, what was Rule 48? Take care, whatever you're trading. Bye-bye.